Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is Bristol-Myers Squibb company, ticker BMY. Over the next few minutes, I'll discuss both the valuation for this company and my thoughts on its business quality. Bristol-Myers Squibb is in the pharmaceuticals industry, and so that tells us a little bit about what they're doing, but more in the business description. They market biopharmaceutical products worldwide, so these are drugs that treat a variety of diseases, including hematology, oncology, which is cancer, cardiovascular, immunology, fibrotic, neuroscience, and COVID-19. It's interesting, COVID-19 has been added there. That wouldn't have been there a couple of years ago. So basically a wide dispersion of various diseases which they are working to treat. Has a very low beta of 0.4795, which is normally a sign of relatively high quality, but we can tell more as we dive into the return on invested capital. So first thing that I see here is they only have 1 year of losses in the last 20 years, which is a very good sign. 19 out of 20 years of profitability is very good. It's a 95% success rate. And the only loss came in 2012, where we might say that they had some COVID impacts, and that could have caused this temporary loss. In addition, you see a relatively huge jump in revenue in 2020, so something weird is going on with that earnings per share number, and it wouldn't surprise me if they had some write-offs that were temporary there. So everything's looking good on return on invested capital. Now, it's not super cyclical. You do spike to 53% in 2009, but it seems more like an aberration. Instead, you have like 14%, 17%, 9, 11, 8, 7, 20, 4, 23, 5. So it is a little cyclical here for the last 6-7 years. And these numbers aren't super big. I'd like them to be more stably double digits, but you have a lot of double digit numbers, a couple single digit numbers, but overall it probably averages out very well. And you can generally see that with this 13% return on equity, which is fine. You like to be above 15%, but you definitely want to be double digits. Return on invested capital of 8.4% is good because we're using a little bit of leverage to get up to that 13% range, which is a very solid number. So all that's suggesting quality company so far. Now, revenue growth of 8% is very good, but what I don't like is that you've had asset growth of 12.7%, which means you're growing your assets faster than you are your revenue, which leads to declining returns over time, which is generally what you've seen. You know, if you go back 10 years, you're at 17%, but you've relatively fallen, if you were to draw a line, you know, kind of through this, as you've had worse returns over the last decade. That's not a good trend you want. Now, you do have free cash flow per share, free cash flow growing quickly during that time, but EPS has not grown as fast as revenue. So you're having some sort of problem with managing your SG&A expenses or something like that that's causing EPS not to keep up with revenue growth. Likewise, the PE of 26 is actually quite high. For a company that operates in the pharmaceutical industry, patents really matter. So while you're under patent, you're going to have really high returns, but when you lose your patents, your returns are going to grow up a lot. So paying high valuations for pharmaceutical companies is generally a trap that you want to avoid. So paying over 20 times earnings is not something I would recommend for a company like this. I'd like to be closer to that 10 to 15 times range when I'm buying stock in a company, especially with pharmaceuticals. If you're liking this video so far, please hit that like button and don't forget to subscribe for more investing videos. Now, as we dive into the income statement, you can see that they're growing their share count over time, which is probably why their free cash flow is growing faster than their earnings per share due to that sort of number. Now, you've seen a massive growth in operating expenses. They probably made an acquisition here that really affects their numbers. If we go to the balance sheet, actually, let's go to the cash flow statement because you're going to see acquisitions here somewhere. Yes, we get a huge acquisition in this time frame, which is really juicing these numbers. For me, it's hard to tell because we need time for this acquisition to flow through to see the income statement, but the capital intensity is just a little high for me. I don't like to be single digits, and so for me, I'm going to pass. I also generally avoid the pharmaceutical industry because they're very hard to predict the future on, and so that plays a lot into my thoughts here. If you like this video, hit that like button. Don't forget to subscribe for more great investing content as I dive through every company in the S&P 500.